Hello traders. A country's inflation rate plays a crucial role in influencing the movement or the trend that its currency assumes at any given time. On this video, we take a look on how the inflation rate of the United Kingdom would affect the British pound as our forecast currency. Kindly remember to like and subscribe. Inflation rate is a significant driver of the currency movements. It can have a substantial impact on the value of a given currency. Inflation is the rate at which the general price of goods and services rises, leading to a decrease in purchasing power. Some of the economic aspects that you look at that are affected by inflation rate are purchasing power parity, import and export prices, monetary policy and central bank reactions, market sentiment and speculative trading, among others. Impact on purchasing power parity. The concept of purchasing power parity suggests that exchange rates should adjust to equalize the prices of identical goods and services in different countries. If inflation is higher in the UK than in other countries, it erodes the value of the British pound. The result is that the pound will depreciate to bring about parity in the cost of goods. Impact on interest rates. Central banks often use interest rate policies to combat inflation. If inflation is rising in the UK, what the Bank of England would do is that it would raise the interest rate to reduce the inflation that is rising in the UK. However, higher interest rates have the impact of making the British pound more attractive to investors who are seeking higher returns. The result is this could lead to depreciation in the value of the British pound. The impact on import and export prices. A higher inflation rate in the UK can lead to higher domestic prices for goods and services. As a result, this can make British products less competitive in the international markets. It follows that the demand for British exports would decrease, thereby putting pressure on the British pound, as foreign players would need fewer pounds to purchase the British goods. The end result would be that the value of pound would decrease. Then let's look at the impact on inflation expectations. Impact on inflation expectations. Market participants closely monitor inflation expectations. If investors anticipate rising inflation in the UK, they may sell the pound in anticipation of its diminishing purchasing power. As a result, this will lead to depreciation in the value of the British pound. As such, other currencies that compete against the British pound would appreciate. So, for example, the dollar, the euro, and the Japanese yen would rise or would appreciate against the British pound or the Britain pound. Let's look at the impact on monetary policy and central bank reactions. The Bank of England closely monitors inflation rate and has an inflation target which is around 2%. If inflation exceeds this target, the central bank may consider tightening the monetary policy by taking measures like raising interest rates. So we see that when the inflation is increasing or when the inflation is rising, the Bank of England will be monitoring to see if there is a chance that it will rise above their target of 2%. And if this is the case, then they would put measures like monetary tightening in place. And they may do this by raising the interest rates. Then, at the same time, inflation has an impact on market sentiment. And we see that investor sentiment can be influenced by inflation data releases and central bank statements. Typically, stronger than expected inflation data may lead to pound appreciation if it suggests that the economy is performing well, but can however lead to depreciation if it raises concerns about aggressive central bank tightening. But at the same time, there are also global economic factors that can also have an impact on inflation and how it affects the currency. We see that inflation in the UK is also influenced by global economic conditions such as commodity prices and trade relationships. Changes in these factors can affect the pound value, resulting in its appreciation or depreciation. Typically, what this means is that if there are weakening trade relations, is that the value of the pound may rise or fall depending with how those trade relationships are affecting the economy of the UK. Then we see that typically traders in forex market may speculate on future inflation trends, which can lead to short-term fluctuations in the currency or in the value of the pound. So as such, you see that inflation rate also has an impact on speculative trading. For example, if inflation in the UK starts to rise at a significantly higher than the Bank of England and targeted, it can cause concerns amongst investors. Investors may fear that the central bank will raise interest rates aggressively to combat inflation, which could attract capital seeking higher yields and potentially strengthen the British pound. At the same time, if inflation in the UK remains well below the target or falls unexpectedly, it may lead to speculations of further monetary easing, such as interest rate cuts, which can put downward pressure on the pound. To summarize, inflation rate is a critical factor that influences the movement of currencies, including the British pound, as we have seen. It affects the purchasing power of a currency, the decision of central banks, trade competitiveness, and investor sentiment, all of which play a role in determining the value of the currency in the forex market. Thank you for watching. Let us meet again in our next video.